We're kicking off today's coverage with a notable Wall Street call cutting against the grain of a broadly weak session. Morgan Stanley has upgraded CDW Corporation, citing accelerating artificial intelligence-driven server demand as a structural catalyst for the company's infrastructure business. This upgrade lands on a day when the S&P 500 is off 1.4% and the Russell 2000, tracked by the Russell 2000, is down 1.67%. Meaning Morgan Stanley's analysts are making a conviction call into genuine market headwinds. The VIX has surged to 20.1, signaling elevated fear across equity markets. Yet the bank believes CDW's enterprise infrastructure refresh cycle is durable enough to outperform through the noise. Morgan Stanley upgraded CDW Corporation, the large-cap Gartner products and solutions distributor, specifically on expectations for accelerating artificial intelligence-driven server demand through 2026 and into 2027. The firm's thesis centers on enterprise infrastructure refresh cycles, where corporations are replacing legacy data center hardware with artificial intelligence-capable server configurations. CDW sits in a critical distribution layer between hyperscaler-grade component suppliers and end enterprise customers, making it a high-leverage proxy for CapEx acceleration. Today's broad market weakness, with the Nasdaq 100 down 0.36%, has not deterred Morgan Stanley from signaling structural confidence in the artificial intelligence hardware build-out as a multi-quarter tailwind. The real driver here is not a single product cycle. It is the recognition that generative artificial intelligence infrastructure spending has transitioned from discretionary to structural. Enterprises are no longer piloting artificial intelligence. They are building out dedicated on-premise and hybrid cloud server fleets, and that requires sustained hardware procurement. CDW's Infrastructure Solutions segment, which covers servers, storage, and networking, sits directly in that spending stream. Morgan Stanley's upgrade signals Wall Street's growing conviction that this CapEx wave is durable through at least 2027. The 10-year Treasury yield sitting at 4.49% is a headwind for long-duration growth valuations, but hardware cycle names like CDW are less rate-sensitive than pure software plays. The direct beneficiary is CDW, but the upgrade carries read-through implications across the artificial intelligence infrastructure stack. Supermicrocomputer is a server manufacturer whose revenue is tightly coupled to the same enterprise artificial intelligence demand Morgan Stanley is flagging. Broadcom and Microchip Technology supply the silicon and connectivity components embedded in those server configurations. On the real estate side, Digital Realty Trust benefits from implied signals that data center lease demand will extend as enterprises expand capacity. Meanwhile, the Nasdaq 100, already down 0.36% today, would be a direct beneficiary if this upgrade catalyzes a broader tech infrastructure re-rating, particularly in a session where the VIX is at 20.1. The most important near-term level to monitor is the 10-year Treasury yield at 4.49%. A sustained retreat below that level would remove a significant valuation headwind from technology and infrastructure names, giving Morgan Stanley's upgrade room to work. On the Nasdaq 100, the 737.95 level is the current pivot. A hold here amid today's broad selling would be constructive for the artificial intelligence infrastructure trade. Upcoming earnings from CDW and peers will be the real confirmation event. Investors need to see the Infrastructure Solutions segment actually deliver accelerating server revenue, not just guidance language. The VIX at 20.1 means options markets are pricing elevated risk, so position sizing around this upgrade matters significantly. Morgan Stanley's upgrade of CDW is a tactically bullish call on the artificial intelligence infrastructure cycle that cuts directly against today's broad market weakness. The S&P 500 down 1.4%, and the Russell 2000 down 1.67% in a clear risk-off session. The thesis is sound structurally. Enterprise artificial intelligence server demand is a durable CapEx theme, and CDW's distribution model gives it high revenue leverage to that cycle. But with the VIX at 20.1 and the 10-year yield at 4.49%, near-term execution risk is real, and earnings confirmation will be essential. That's the full picture on Morgan Stanley's CDW call today. Coming up next, another story with direct implications for equity and credit markets. Pivoting now from our first story to the macro policy backdrop rattling every major index today. White House National Economic Council Director Kevin Hassett sat down with CNBC this morning as markets were already deep in risk-off territory. The S&P 500 declined sharply, while the Nasdaq 100 shed significant ground. The VIX spiked to 20.10, a level that signals genuine investor anxiety, not routine hedging. When a senior administration official steps in front of cameras on a day like this, every word carries outsized weight for traders parsing policy signals. Hassett's appearance covered three distinct pressure points that are simultaneously weighing on markets right now. The escalating Iran war risk premium, questions about the Federal Reserve's legacy and policy trajectory, and the administration's read on the underlying health of the economy. This came as the 10-year Treasury yield jumped to 4.49%, up 94 basis points on the session, and the 5-year yield moved to 4.26%, a sharp move that reflects bond markets pricing in both inflation persistence and geopolitical tail risk. The Russell 2000, tracked by the Russell 2000, fell 1.67%, demonstrating that smaller, more domestically exposed companies are absorbing the most pain in today's session. This is not simply a routine policy interview. It arrives at a moment when two independent macro forces are colliding with unusual force. Iran-related geopolitical risk is injecting a war premium into energy, defense, and volatility markets simultaneously, while unresolved questions about the Fed's next move are keeping the Treasury curve under stress. The 13-week T-bill sits at 3.69% and the 10-year at 4.49%, meaning the curve is being pulled from both ends. Hassett's commentary on Fed legacy is particularly significant because any hint that the White House views the Fed's current stance as too tight or too loose can amplify rate expectations and drive bond and equity repricing within minutes of broadcast. The tickers most directly in the crosshairs today span multiple sectors. The Russell 2000 is the clearest expression of domestic growth anxiety. Small caps have no international revenue to cushion a U.S.-centric policy shock. The Nasdaq 100 shows that rate-sensitive megacap tech is equally exposed to the yield spike. On the safe haven side, gold is holding up relatively well despite the risk-off tone, a sign that some capital is rotating toward hard assets. W&T offshore crude and Brent are under pressure, a counterintuitive move given Iran tensions, suggesting demand destruction fears are currently outweighing the geopolitical supply risk premium in energy markets. Traders need three specific levels on their radar right now. First, the 10-year Treasury yield at 4.49% is the single most important Fed policy barometer in today's session. Any move materially higher accelerates equity multiple compression, particularly for the Nasdaq 100. Second, the VIX at 20.10 is the fear gauge to monitor. A sustained move above elevated levels deepens institutional hedging demand and can trigger systematic de-risking from volatility-controlled funds. Third, the S&P 500 has technical support near 730. Any breach of that floor on volume would invite momentum sellers. Industrial commodities also deserve attention as a leading indicator of industrial demand sentiment amid geopolitical uncertainty. Here is the single actionable truth from today's Hassett interview. In the absence of hard economic data, qualitative policy commentary from senior officials becomes the market-moving catalyst, and right now the market is priced for uncertainty rather than resolution. The VIX at 20.10, the 10-year yield at 4.49%, and the Russell 2000's decline of 1.67% collectively tell you that investors are not yet convinced the geopolitical and Fed risks have peaked. Defense names and energy remain the tactical hedges if Iran tensions escalate further, while long-term treasuries and gold serve as portfolio buffers if the macro deteriorates. Those are the two stories that matter most today. The full breakdown is up, and every level you need is right here. If this breakdown gave you an edge, hit subscribe and turn on the notification bell. We publish these deep dive market recaps every single trading day, so you never walk into the open without knowing exactly what moves matter and why.